Hello, everyone. I'm Sandra Boss, Global Head of Investment Stewardship at BlackRock and a member of our firm's Global Executive Committee. I'd like to thank the Korean Network of Women in Finance for inviting me to speak with you today. It's an honor to be here, along with my distinguished fellow speakers, at one of the most important annual financial services events in the region. I'd like to begin my remarks with some personal context. This will help explain why I am passionate about the role the diversity of personal perspective, professional experience, and ultimately diversity of thought can provide in business endeavors. I've spent my career enabling financial institutions and other companies to deliver value for their shareholders and other stakeholders. As a senior partner and global leader at McKinsey, shaping company strategies and helping drive execution. As a member of the Prudential Regulation Committee at the Bank of England, taking supervisory and policy decisions that affected banks and insurance companies authorized to do business in the UK. And as a director and committee chair of listed companies and of the committee that oversees all the sterling clearing and high-value payments in the UK. I've also spent most of my career as the only woman in the room, or one of only a few. I've been part of high-performance teams and boards where all members were valued for the quality of their ideas, their contributions and impact, valued because of their differences, not despite them. But I've also seen groupthink in action, as the desire to please an alpha male, usually it was a male at the head of the table, silenced dissent and stifled creativity and collaboration. That can't lead to the best outcomes for shareholders, employees, or other stakeholders, and there's plenty of research that says that it doesn't. Personally, I have witnessed significant improvements throughout my 30-plus year professional career, but there is still much to do globally, and particularly here in Asia. Today, I'm speaking as BlackRock's head of investment stewardship. At BlackRock, the assets that we manage on behalf of our clients, who are the true owners of the companies that we invest in, represent the futures of millions of people across the world. Our investment stewardship team advocates for the sound corporate governance and business practices that lead to sustainable long-term financial returns, which our clients depend on to meet their investing goals. At BlackRock, we are long-term minority shareholders in public companies on behalf of our clients. So as a result, we can form durable long-term relationships with company boards and executive management teams. Our active and ongoing dialogue with the leaders of these companies gives us high-level insights into their business strategies, their financial performance, and the challenges that they face. Our fiduciary duty is central to our role as an investment manager. We are focused on what is in the long-term economic interests of our clients. It is their money that we manage, not ours. And it's through our investment stewardship activities that we encourage companies over the long term. We encourage them to focus on material sustainability issues like climate change, fair treatment of workers, or racial and gender equity, as well as traditional financial issues. And that's because it is our conviction that when companies are well-governed and managing systemic as well as idiosyncratic risks, that will translate into durable economic returns for our clients, the owners of those companies. Now let me turn to why we believe that board and workforce diversity is an investment issue for our clients. Board quality and effectiveness has always been a core engagement priority for our stewardship team. We've seen how effective boards can play an important role in developing and overseeing strong management teams. Companies succeed or fail over time because of their people, and people in leadership positions in the board and in the executive can impact how companies perform. For several years, we've taken a multifaceted approach toward evaluating board diversity. We regularly engage with members of nominating or equivalent committees to understand the director recruitment process and efforts to facilitate a diverse, qualified pool of candidates. We expect boards to have credible views on several important diversity topics: how the board's composition reflects the diversity of the company's key stakeholders and prepares it to make the decisions it needs to do in pursuit of its strategy. What's the board's approach to refreshment and the extent to which diversity is a consideration as the board goes through that refreshment process? What are the steps the nominating committee is taking to enhance board diversity, for example, making sure there's a diverse candidate slate? And what is the process, and how does the process of appointment address unconscious bias? This is a priority as we believe that board diversity is an important factor in enabling quality leadership and financial performance. Companies with more diverse leaders will be able to foster the right environments for innovation in the boardroom and, by extension, throughout the company, while also avoiding the perilous dynamics that can lead to groupthink. In fact, our own early research across sectors on this topic indicates a positive correlation between companies with strong representation of underrepresented groups and outperformance in market valuation terms when compared to peers. We believe that companies have a role to play in advancing human capital development and in fostering a more prosperous and inclusive society, adopting better diversity, equity, and inclusion practices, both in the boardroom and the workforce. We see that this can create a virtuous cycle that reinforces a company's social license to operate. For example, investing in efforts to build a strong local workforce in the community in which a company operates may bolster economic growth. That, in turn, can have a positive effect on local consumers. Similarly, workers who resemble a company's target consumers may empathize with them more and spot opportunities sooner for new products. But we're also concerned, I'll be honest, about recent setbacks in workforce diversity. Unfortunately, it has become increasingly clear that while COVID-19 has affected every individual and business around the world, the pandemic has had a disproportionate impact on working women globally. Around the world, women are leaving the workforce at greater rates than men, largely due to a disproportionate share of responsibility for childcare and household responsibilities in the wake of COVID, and this is still ongoing. It's unwinding the hard-won gains of recent decades in bringing women into the workforce and leadership roles. It's also exacerbating a retirement savings crisis for millions of women. This is, of course, a social and moral issue, but as investors, we really mind that it is also an economic risk. The loss of a substantial portion of the workforce, the resulting reduction in personal financial strength, it's a risk for economic development, and it's a profound risk for companies, their long-term shareholders, which include our clients. So if we turn now to BIS engagement and voting on diversity in the boardroom, BIS being BlackRock Investment Stewardship. For the reasons I've laid out, on behalf of our clients, we are advocating for diverse boards and management that help set the right tone at the top, as well as a diverse and inclusive workforce that resembles the community in which the company operates and serves. We look for boards to articulate their own policy on diversity, including gender diversity, and to engage with management on advancing diversity in the company. We have, I'm very happy to say, witnessed significant gains in board diversity in many parts of the world, thanks in part to engagement by investors. As of June this year, for example, all the companies in the S&P 500 index now have at least one female director, with an average of nearly 30% of board seats held by women. The UK has had similar results. But there's still much to be done, and we see some companies not yet showing the level of urgency that we would hope in integrating diversity into the boardroom. Now, if we observe insufficient progress on enhancing diversity at the board level within a reasonable time frame, and very much in the context of regional norms, we may use proxy voting to vote against directors for this reason. It's something that we're doing already in many parts of the world. So globally, in the proxy year that ended in June 30th of 2021, we voted against more than 1,800 directors at 975 unique companies for concerns that were related to board diversity. In the Americas, lack of board diversity was the leading reason for votes against management in the proxy year that ended June of 2021. In EMEA, our diversity-related votes in the same proxy year almost doubled over the prior year. Now, in Asia, the stage of dialogue is much earlier. We are really focused on prioritizing, engaging with companies, encouraging more board diversity and quality. But we've also recently introduced proxy voting guidelines on board gender diversity. In Singapore, Hong Kong, and Malaysia, we are looking for at least one woman on company boards. And we expect to implement the same policy in Korea in 2022, as recent changes in listing rules come into effect, mandating one woman on the board of listed companies with assets of at least 2 trillion Korean won. Now, I've been asked for some examples of what other countries are doing to make progress in this area. I've already touched on the role that engagement and voting by BlackRock and other asset managers are playing, and I won't spend more time on that. That has been having impact. But I think it's important to note that our work as asset managers is very much in line with other efforts that are being taken by governments, by regulatory bodies, and other industry participants. The progress that we are seeing around the world on board diversity is very much the result of a concerted effort from across the ecosystem. And this is also true in Asia, with more governments mandating or at least recommending greater female board participation. So let me now get into the 4 types of initiatives that we've seen have a significant impact. The first, legislated board diversity quotas. So the governments of France and Norway have led the way, mandating over 40% female board representation. And this has rapidly resulted in the proportion of female directors being much higher in those two countries and even elsewhere in Europe. We are, as a firm, always wary that a legislated quota can lead to box ticking. But what we've actually seen is that when designed and implemented correctly, as in these two countries, such quotas can be effective. Second initiative, market-level work from regulators and governments. So, for example, in the UK, thanks to the government-sponsored Hampton-Alexander Review, nearly all FTSE 100 companies and more than 150 companies in the FTSE 250 now have at least 30% female participation in company boards. They're now increasingly focusing their attention on the role of gender diversity in the executive suite, where progress lags at the level of CEO and CFO. At the same time now, the UK's Financial Conduct Authority is currently reviewing whether to ask companies to comply or explain with a new 40% female board representation target. Several markets in Asia, like Malaysia, Thailand, and Singapore, have corporate governance codes that take a similar comply or explain approach to disclosure around board gender diversity. The third item is listing rules. Board gender diversity is a very active area for listing authorities globally. In Europe, listing rules include mandatory quotas in Italy, Belgium, Portugal, Germany, and Austria, as well as France and Germany. And at the same time, listing rules recommend voluntary targets in Denmark, Sweden, Finland, and the UK. In the US, the NASDAQ has recently gone further. They've adopted a very progressive comply or explain expectation that companies have at least 2 diverse directors, including 1 female director and 1 from either an underrepresented ethnic minority group or the LGBTQ+ community. Elsewhere in Asia, the Securities Exchange Board of India has mandated at least 1 female board member since 2015. And in Singapore, the Singapore Exchange Regulator is now consulting on a proposal that issuers set and disclose their board diversity policy, including targets and plans for achieving them. The fourth initiative type is voluntary private initiatives. The 30% Club's investor group is a global effort to coordinate the investment community's approach to diversity. It's had phenomenal impact, encouraging progress toward 30% female board representation across 18 countries. We have seen significant change in the UK, the US, Australia, and Japan as a result of the group's work. In Asia, the 30% Club has chapters now in Hong Kong, Japan, and Malaysia. And similarly, in Singapore, the Council for Board Diversity that was established by the Singaporean Ministry of Social and Family Development promotes an increase in female representation on boards. They've targeted 20% by 2020, 25% by 2025, and 30% by 2030. So now let me turn to what our aspirations might be for South Korea. In Asia, we've obviously seen exchanges, regulators, market stakeholders in many countries, Malaysia, Singapore, Thailand, and Hong Kong, advancing progress to get more women on boards. We've seen an encouraging trajectory in those markets. Some are now getting close to 30% female representation on boards, and we'd like to see the same progress in South Korea. Unfortunately, in the KOSPI 100, only 5.2% of board members are female today. Korea is actually ranked at the bottom of 29 OECD countries for 9 years, with less than 4.5% female executive ratio across the KOSPI 200. More broadly, women only hold 4% of executive positions in Korea, despite making up 50% of the workforce. We think that tone from the top is critical. It's important for women in the workforce to identify with their leadership, and understanding barriers to advancement is critical to achieve real change in gender representation. Korea's economic rise in the past 60 years is often called the miracle of the Han River. It was one of the poorest countries after the Korean War, with no natural resources to boost development. But one of the competitive advantages Korea has always had is its human capital, its talent. Today, Korea's export-driven economy is being challenged by other emerging market neighbors, not least among them China. So it's in the natural interest of Korea to maximize the use of its competitive advantage and harness the intelligence and the intellectual capital of its workforce. So we very much welcome the revision to the Financial Investment Services and Capital Markets Act that requires the boards of sufficiently large listed companies to have at least 1 female board member. But very importantly, we hope that this is just the start. So I'd like to conclude by saying that our work to encourage greater female participation on company boards is part of our fiduciary approach on behalf of our clients. We believe it encourages long-term value creation at companies. Not only would we like to see more women on boards, but we want to see that women are set up for success. A single woman on the board can feel like a token. I have been there. It can be frustrating and exhausting at times. Additionally, it does nothing for companies or our clients who are invested in them if women are elected to boards but are never put into leadership roles. We need to see meaningful representation of women in committee chair roles and chair roles on boards. We need to see women have seats at the table, for this to be the standard, not the exception, but also for women's voices to be heard. Thank you very much for your time today.